All right.
Hey, good afternoon. Welcome to this Tuesday's session of Insider Secrets, and that's brought to you by My Core Intentions. Before I introduce our guest today, let me take a quick minute for a commercial. You know, My Core Intentions is designed to deliver proven real estate strategies through personalized coaching to help facilitate a positive life change for our clients. We do this by delivering proven strategies, podcasts like today with an expert. So I'd like to hear from you either by email or by a phone call about your practical plan and what your growth plan is and what your intention is for building your business. If you're considering coaching or someone to help you draw out that plan, give us a call. Go to our website and you can register for a free coaching session. And how are your intentions? What are they? What are you looking to accomplish? You know, let me take a minute here and introduce our guest for today. Give you some things to think about in your own real estate investing career. But I'm joined today by my good friend and real estate investor from Orange County, California, Forrest Correll. Forrest and his family live outside of Irvine. He's a seasoned real estate investor with a formula that really works. Forrest is going to talk to us today about strategy. And I think that that's really important. Something we all need to look at as investors is our strategy. You know, strategy around, you know, your focus, your standards, what market conditions are. Forrest, why don't you say hi to our listeners and tell us in one word what describes your investing strategy?
Well, thanks, Mike. I really appreciate you having me today. It's such a wonderful day that we all get to get up out of our beds, and I'm super thankful, and I'm super thankful to be here. I would say if you were to ask me what's one word that would describe our strategy, it's commitment. If you're committed, being committed doesn't mean that you won't fail or have setbacks, but being committed over time illustrates that you will be successful. So that's what I would say is commitment.
That's staying in the game for the long haul, right? You know, over and over, doing the same.
Absolutely.
So Forrest, why don't you do this? You know, I think that's great. And why don't you tell us a little bit more about that commitment? Tell us about yourself, your backstory. You know, how'd you wind up in multifamily investing?
Well, that's a good question. It's pretty much a miracle. I'll say miracle several times, but you know, I was some poor kid from the wrong side of town in Los Angeles that was just encouraged to go to college, didn't know what for. I fell kind of ass backwards, I'd like to say, but it's more of a miracle into accounting. I did well enough in college at a state school here in California to get hired at a large publicly traded or a large accounting firm that specialized in commercial real estate here in Newport Beach, and didn't really understand what I was getting into until I was there. But all of the clients that I was working on, that were publicly traded home builders, publicly traded land developers, et cetera, et cetera. This division of Ernst & Young specialized in commercial real estate. So most of my clients were all commercial real estate clients. And so it was at that time that I learned trial by fire, or just merely a war of attrition, of working on cash flows, looking at vertical and horizontal construction. And then I was there for a couple of years, and got recruited away to work for a large brokerage firm, commercial real estate brokerage firm, and then eventually got hired away to work for a publicly traded home builder, where I was lucky enough or blessed enough to acquire approximately 15,000 multifamily units over the country. Over 8 years, I ended up I was there on contract basis, meaning I was there for a couple of months, and when that couple of months contract was up, they asked me to stay another month, and then another month, and as the miracle goes, I ended up being, one of the CFOs, and did a lot of business. Then I'd say in 2006, I left with a pile of money. I doubled down on this market, probably obviously at the wrong time. Then by 2009, I probably was working out all of my deals, my multifamily deals that I had purchased in 2006 and 2007. But the one thing then during, I'd say during 2012 to 13 to 14, I probably acquired or helped acquire about 1,700 residential homes throughout the United States. It was a unique space niche that we had. It probably too long to describe on this phone call or webinar, but then in 2015, 16, I semi got the band back together, or some of my competitors, and we formed our current partnership, which is since about 16 and 17, we've bought about 2,000 multifamily units all over the Southeast, or what I would call the smile part of the country, which is really where our target market is. It's from all the way up from Seattle, if you can picture this in your mind, from Seattle down to Vegas, Tucson, Phoenix, many markets in the Texas area, Atlanta, all of Florida, almost, except for Miami, then up the way through the Carolinas, then all the way to the Mid-Atlantic. So if you kind of draw a smile on the continental United States, it would look like the Mona Lisa smile is what we call it. And we're vertically integrated. We self-manage all of our assets, which is a total of about 3,500. And we're constantly looking for two things: constantly looking for deals and constantly looking for capital.
So
and that's the cocktail version.
So if any of our investors out there had any deals in any of those markets that you were looking at, or had an interest in capital, they could call you and see you, and we'll get your information at the end of the call.
Certainly.
But, it sounds like you've had a long, committed period of time in that market. And the thing that I find interesting in a lot of conversation with a lot of multifamily people today is, why should I go outside of my market? Why should I stay in my own market? And I think both you and myself in our investing strategy over the years has been, our market where we live might not make the most sense when we can go somewhere else and buy a product that we can buy for less cost of capital and make more money on. So
Correct.
Do you want to talk about that a little bit?
Sure. In the let's see. So I've been in this business, the multifamily business, since I'd say the mid to late 90s, and with the advent of technology, technology allows you to fire over the horizon. Meaning, most of you know that the horizon kind of bends every, call it 50 miles, the curvature of the Earth. It used to be in the old days, so I've heard, that in the 70s and 80s, you wanted to buy a property outside of your neighborhood that was no further than a couple of hours from the nearest international airport. In the 90s, the late 90s, with the advent of the internet, and into the 2000s with the increase in the technology, the property management software, the internet, the ability to communicate via cell phones and iPads and et cetera, it's brought the fight, I would say, or the investment closer to your living room couch, so to speak, or your office. So what we do is we're a very decentralized management company where we have our vertically integrated property management company. Our business partners are in 5 different locations throughout California, north and south. We have all of our corporate property management corporate staff is in different states. We probably have about 80 to 90 employees that oversee make up our property management vertical. And to that point of not being in your market, investing in your market, technology, I'll land the plane this way: technology allows you to fire over the horizon. Yeah. It's the force multiplier that gets you to where you need to be.
Yeah, it's interesting. Everybody thought, technology was going to make your life easier. And then we went through that period of time where it was confusing. And now technology really helps to source deals, to look at deals, to do things from your couch at home that you would normally have to get on an airplane to go do. So investing outside of your market generally becomes a little easier.
Yeah, I'm on the, just to make a point of that, a little hyperbole, to create a little hyperbole here. It's just like I always tell my family that one day your dad's going to come out with a book that says how I bought $1 billion worth of commercial real estate or apartments in my underwear on my couch. And that's, it's funny, but it's also true. It's certainly very much possible. And
Yeah.
I'm living
And it's interesting.
proof of that.
Everybody wants to work from their couch at home in their underwear, you know? Every,
Well, nowadays, maybe not so much with everybody on top of each other, especially if
yeah.
you live in New York.
So we are in the middle of the coronavirus, or coming to the end of it, hopefully, during this. But, remember that comment, remember when you wanted the weekend to last forever? Be
Oh,
careful
I
what you
know,
wish for.
exactly. You want Mondays to come more than not.
So you said you own about 3,500 doors right now. Can you tell us, what that portfolio looks like? Size of complexes, and, do you have management in place, or are they, what does that portfolio look like?
Yeah, so that portfolio is so I'll start with our target. Since I'm the chief investment officer, which is more just a fancy word of saying I'm the guy that goes out and selects the widget and kicks the widget, visit the widget, and then underwrites the widget so that my partners could look at it and we could roundtable on it and decide whether we're going to write an offer or not. And it's a very highly fluid task, meaning the widget comes in, I look at it, and then we underwrite it. We have a couple of analysts, and then we caucus on it, so to speak. But the makeup of the current portfolio is all throughout the Smile part of the country. As I mentioned earlier, we don't buy anything apropos of our target box, our target acquisition box, is that we don't buy anything less than 150 units or less than $10 million in empirical value. I would say that there's two ways to get widgets or to multifamily assets. There's through the brokerage community or principal to principal. And in either case, you need to establish a beachhead in a market. For instance, in Atlanta, I probably bought 4,000 units in Atlanta before the last market cycle. This past market cycle run up, we probably have about 8 assets in Atlanta or 1,500 units. But early on, I'm going to answer your question here in a second, but early on, there's already a bunch of players in Atlanta, established players. So what you have to do to jump in or parachute into a market is you might have to buy an asset that you wouldn't normally buy. For instance, we bought an asset on the south side of Atlanta, approximately 15 miles from downtown Atlanta, that was 138 units, and it was built in the mid 70s, and which isn't an asset that we'd normally buy, which is under the 150 units, which was built in the 70s or later. We wouldn't normally buy that, but to jump into a market, sometimes you have to buy something that you wouldn't normally buy just to establish your presence in that marketplace, which is the point that I'm really trying to make here is that nobody's saying that we should buy stupid things or stupid widgets, but sometimes you need to bend your own tolerances to get into a market.
Yeah. So you need to stretch your own capacity, So when you talk about that, though, if we talk about product class A, B, C, so what do you normally buy? What product class do you normally buy, and what would be a stretch for you?
We normally buy in a market that we have a concentration in, like in Atlanta. We're only looking at assets that are over 150 units minimum, that are 80s and newer, so 80s, 90s, 2000s.
Okay.
We're even looking at merchant built deals that were just built last year in Atlanta. I would say in the San Antonio market, we're doing the same thing. In the California market, we're doing the same thing. But in other markets that we'd love to be in, let's say like Raleigh, North Carolina, we'd buy a 60s vintage deal just to get into that market. It's a top 20 market. A lot of players are in it, a lot of sophisticated money, a lot of folks, a lot of players in the $10 million and above space. So it's a knife fight to actually get a deal.
Yep. So what's interesting is you talk about standards, and you have these specific standards depending on the market that you're going into, product class, type of product, year, and I always encourage my clients and my coaching clients that what you need to do is you need to have these written standards. You need to know what you would buy in what market. So what's interesting is that in Atlanta, you're not going to buy a 60s product, but you'll go to Raleigh and buy a 60s product. So
correct.
So it's different.
Correct.
So,
correct.
The one thing that I'd like you to talk a little bit about is, I talk to my coaching clients a lot about sourcing deals and the best way to find deals. And you talked about the difference between the brokerage community and finding deals through them or going direct to the owner. Where do you find not only your best deals, but the most? Where can you find, the greater ease of seller?
Well, it's definitely, I would say, and I've bought both in the last 3 years. I've bought both. I've bought anywhere from 50 million to 25 million to 10 million to 1 million here in Orange County. And I would say that that the multifamily game in primary markets, like in Atlanta, like a Vegas, like a Phoenix, even like a Tucson, deals that are above $10 million and up are very competitive. And all this is pre-corona. It's very competitive. You're dealing with smart people who have ostensibly a black credit card. And by black credit card, I mean that you could buy anything you want with a deep capital bench. So I would say the greatest opportunity is south of $10 million. And even more so south of $5 million, there's less sophisticated competition. And I don't want to say dumb competition. I just want to say that, or characterize it as competition that is less in tune with the marketplace, the stock marketplace of multifamily. Meaning that if you look at the NASDAQ today, it goes up and down every second. That's how the multifamily market is for an institutional buyer, such as ourselves. But at the $1 million range or the $5 million range, it's less in tune. They look at, the analogy is that they would look at their stock portfolio like once a month when they get their statement. So they're just less in tune with the ebbs and flows of the real marketplace. Doesn't mean, I'm not saying that they couldn't get in tune. They're just by their very nature, they're less in tune because they're focused on other things, if that makes sense.
Right. So if you were going to go today and search for a owner that's selling a property, not to reveal all your secrets unless you want to, but how would you go about doing that? What's your best for tracking?
Yeah, that's a great question. I would, and I have such a heart for the small investor because I was a small investor back in the early 90s, mid 90s, before I was blessed with all these opportunities. I would say you have to look, first of all, you have to ask yourself, do I want to fight a battle over the horizon? Most of us will say yes. So the next thing, the next thing that I would do in the funnel of sussing out where you want to be is I would look at where smart money is. 20 markets.
There you go.
I would look in the top 20 markets, and you could go, Michael Milken, the Milken Institute has a great research report. You could just Google it, Michael Milken real estate top 200 markets. Every market goes up or down every year based on two biggest things: incomes and employment. If you don't want to be in a market where you have negative employment or negative migration. I don't know. I don't want to pick a city because I don't want to put a cloud on any city, but let's just say the Michigans of the world back in 2007 or 8, relative to the Orange County, markets, either, that historically have been strong. So you want to be in a strong market. Plenty of data out there that's not top secret, that you could just Google. But follow the smart money. The Michael Milken Institute's a good one. There are a couple others that I would chase that are okay, but that failed me right now. Milken's a good one. So let's say you pick a market like Nashville. So you're in Nashville and you say, I could only tolerate deals that are between 1 and 5 million. I would definitely follow the smart money. You have plenty of operators, multifamily operators are out there that are buying deals, renovating deals, and moving rent. Okay, from a value add standpoint, those are the guys that you want to draft off of. Okay, the smart guys, and you could pretty much go to any top brokerage, CBRE, Berkadia, JLL, any local brokerage as well, commercial brokerage, and you could ask them who are the biggest buyers in that marketplace. This is all information that you could go dig up. And once you find the big money buying assets, then you want to draft off of them because it's like a Walmart. A Walmart does a lot of investigation before they do a capital investment to build a Walmart. So that's essentially what you're doing. If you had a donut shop, you might create a donut shop close to the Walmart because there's traffic. So I'll land the plane here in a second. So once you identify your target market and you find the big players that you want to draft off of, you want to now get some sort of investigative software that allows you to farm that area. Figure out who the buyers are or who the owners are and how long they've owned it. Another key thing is to determine what kind of debt they have on it. Is the debt coming due soon? A lot of multifamily, don't forget this. If you learned one thing today, learn this. A lot of multifamily guys like to put fixed rate debt on there. But we don't do that. Fixed rate debt equates to prepayment penalties, okay? We're in an elongated, low interest rate environment. Putting floating rate debt with a interest rate cap allows you the flexibility to get in and out of your deal after 1 year. Whereas fixed rate debt, I think I said that right. Floating rate debt allows you the flexibility. Fixed rate debt penalizes you. Fixed rate debt forces you to time the market. Okay. If you know anything about yield maintenance or defeasance, or I would wrap all that up into prepayment penalties. Boy, we could throw a dart in a market and just hit a home run and like a Nashville. And after 2, 3, 4, 5 years say, geez, I want to sell this because I've doubled my money, my asset value. But if you've got fixed rate debt on there and it's got still some term on there, boy, when you calculate the yield maintenance or the prepayment penalty, boy, you're going to be a sore loser.
Yeah. So what's interesting is you're talking about debt and you're talking about fixed rate versus floating. The one thing you said is timing the market. And I think a lot of investors sit on the sidelines because they say, well, I can't time this market. I can't figure it out. You're going to invest in any market. You're not going to say because it's high or because it's low, I'm not investing. You're going to invest in any market. And I think that's where most investors need to get off the couch and get out there and do some investing. You know what I'd like you to talk about for a minute as we're on this conversation about capital is the difference between private capital and institutional capital. And, what are you looking at for sources of capital out there today? What do you see as availability and where the market's going to go, especially over the next 180, 240 days here?
Well, let me first try to answer that question. I know I've got the answers. The difference between private capital and institutional capital is other than the words, is this. If you have, and believe me, I've done at least $1 billion with Lehman Brothers and other pension fund advisors. So I've had a lot of institutional equity experience. When bad times, the good thing about institutional equity, it allows you to buy scale, 10, 50, $100+ million deals, and because they only want to chase large deals. However, the downside to institutional capital is two things: the reporting elements that you have to do on a monthly or quarterly basis. A pension fund is like a proctology exam every month or every quarter from a reporting standpoint. And if you mismanage the property, or the cycle hits you and you're over leveraged, and the lender is coming with their handout and wants you to rebalance the loan, the equity, the institutional equity, they're quicker to cut bait on an asset, because you got to understand that they own billions and billions of dollars, and your one little deal at 20 million is a drop in the bucket. So when they make a decision, they will make a decision, and you could get totally wiped out your co-invest. Conversely, on a non-institutional equity, they're more tolerant with making those kinds of decisions, in my experience.
Yeah. So that's something that we want to look for, is we want to look for that tolerance with our capital today, where we're going to be able to, if something should arise or some situation come up, we're going to be able to ride the storm out, so to say.
Yeah, you want to partner, Mike. You want to partner, not somebody that's going to make a decision from their ivory tower, and you're just another number.
Right. The thing that you said a few minutes ago about the small investor, I think a lot of times, somebody could be listening to this podcast right now and saying, oh my gosh, I'd never be able to buy a 150 unit deal, much less 3,000 units. But I remember when I first got in the multifamily business, I didn't think I'd ever buy a 200 unit deal. And then I bought one, right? And all of a sudden your whole paradigm shifts. But I want to talk to the small investor for a minute, just the guy who says, you know what, I just want to buy a 6 unit or a 10 unit or a portfolio of 10 unit buildings. The capital's out there. The timing is right. Go ahead and build your portfolio that way. What advice would you give to the small guy today that might be the same or might be different than what you would give to a larger investor?
Yep, I've got it. Which is the same advice that I give my wife and my kids. Okay, I give to your folks, because as I said earlier, I have a heart for the small investor, because I was a small investor. Right. At one point, I used to own just five homes in a tertiary market here in tertiary market of Los Angeles. I would say this: if you just got a little bit of money, you want to be in a market that is a larger market, that's close to home, as close as possible, even if it is a plane ride. And you want to follow the smart money. And I would say a lot of people buy and hold or buy and flip. Okay. I will purpose to give your folks advice to say, you buy and flip multifamily assets, small multifamily assets. You could do that. You could go into a market and buy a 4 unit, a 6 unit, and go in there and you could buy a widget that's been owned for 5, 10, 15, 20 years. And then the rents are half of what they could be, or some version of it. You could go in there and throw a lot of money at the insides and move the rents 50, 100% in some circumstances.
So here's what's interesting. You talked about
I've done here,
buying a 4 unit.
I've bought a 2.5, believe it or not.
You've
grown the rents $1,000 a unit and sold within a year. I'm telling you, that's a business plan. And I would encourage anybody that's just got a little bit of money to one day it's fine to buy 100, 200 units, but you want to hit singles and doubles. This is singles and doubles investing in multifamily.
Yeah. We always talk about, hitting the single. You get up to bat every time and you hit a single, but once in a while you hit that triple or that home run, you've done well. So, back to that small investor for a minute, even if you're just buying 4 unit and 5 unit buildings, that's a residential loan. That's not even a commercial loan. So you can start your investing career. You can start to
Yes.
build a portfolio on that residential platform and graduate from there. I always equate it to playing the game of Monopoly, right? You want to buy a bunch of things, put them on Park Place and Boardwalk, where the smart money is, turn around, sell them, and put a hotel up there. So that's what helps grow your portfolio. Well, listen, we're coming to the end,
Yep.
and I
Yeah.
want to
It's
thank
easy.
you.
It's almost as easy as that.
I want to thank you for your time today. And we seem to have some technical stuff going on here with communication, but I want you to tell people how they can get a hold of you for, if they have deals that they want to float your way or capital your way, how would somebody get a hold of you today?
Well, I'll give you my email address and not my home address. But my email address is Forrest with 2 F's, FORREST, at PRAXCAP.com. That's PRAXCAP.com. 4-step Praxcap.
Okay, great. Well, Forrest, I want to thank you for your time today and really appreciate all your insight and your input. No doubt I've always had a lot of respect for you and for your knowledge, and know that, you're continuing to stay committed to the market and committed to your investment strategy. And that's the point that we tried to bring through to people today. And I hope they got a good grasp, a lot of good things talked about today. So thanks for your time and have a great day. And everybody out there, we'll talk to you soon.
You too. Take care.